Shall we start?
Yes.
A very, very warm welcome to everyone this evening. We are really encouraged not only by the number of people who have registered for this event, but the fabric of the audience we have got today, which is from so many different locations and across all age groups. As we start this very unique event of how to start your risk consulting practice, how to develop your risk consulting practice, I first request Mr. Abhay Mehta, President of the Bombay Chartered Accountants Society, to introduce the organization and its ethos to the audiences who have gathered here in large numbers. Over to you, Abhay Bhai.
Thank you. Co-chairperson of Internal Audit Committee, Ms. Nandita Parekh. Speakers, Mr. Rama, Warrior and C. Hersh Shah. Convener Prajit, seniors and all virtually assembled participants. A very good evening to you all. We all are living in a world where complexities of carrying on businesses are increasing manifold due to tectonic shifts in technology, which has become a key driver of most of the businesses. The stakeholders are mandating management to continuously assess the risks involved and also to ensure taking steps to mitigate each of such risks. This session has been planned with the intent to familiarize CA professionals on the opportunities which are unfolding in the sphere of risk management. Along with it also to provide them an overview of the manner in which they can equip themselves to commence their journey as risk consultant. I do not want to delve into the topic per se, but I am here to convey my gratitude to all for registering and participating in such a large number, as well as to make you all aware with the activities of BCS, since majority of the participants are not BCS members. It is heartening that the participation is pan-India, with registrations of more than 750 out of 1,000 plus, being from more than 150 cities and towns other than Mumbai. It is proud to state that there are 3 participants even from Abu Dhabi. Risk consultancy is an area of practice for the future, can be gauged from the participants' age profile. There are 300 below the age of 30 years and 300 between the age of 30 to 40. Further, 90% of the participants are from practice. Coming to BCS, it is the oldest voluntary professional body of chartered accountants established in the year 1948. I would urge you all to visit and surf through the website and also through the resources and events on our website. You all may also follow BCS on social media, where we have more than 50,000 followers. Recently, BCS LinkedIn follower base has crossed 15,000 mark, and there are more than 20,000 YouTube viewers. We are an 8,000 strong family and have ambitions to reach a magical figure of 10,000, which can be achieved with support from learning enthusiasts like you all. You all should subscribe to the prized publication BCA Journal, which keeps one abreast with the latest developments in the regulatory regimes of India. This will enable you all to appreciate the quality of events and resources which shall be at your disposal if you enroll as BCS members. At the end, let me wish you all a very happy learning and hope this session opens up new vistas of professional growth going forward. I now hand over the proceedings to Ms. Nandita Parekh. Thank you.
Thank you, President Sir, for your introduction. So now I have the pleasant privilege of introducing the 2 very dynamic speakers for the day. I will start with Mr. Rama Warrior, whom I have not had a chance of meeting in person so far. Eagerly looking forward to your session. Here is a person who has set up and he runs an independent management consulting practice, which provides consulting and advisory services to several large corporates in India and abroad. His area of expertise ranges from risk management to blockchain, AI, and he is at perhaps the cutting edge of the skills that are so sought after by people across ages today. Prior to his present venture, he was the managing partner of Infosys Consulting. In his role, he spent over a decade and he has been an advisor to large transformation programs of corporates in North America, Europe, Middle East, Asia, and Australia. With such vast experience in both the corporate sector, in the insurance industry earlier, and being in his own practice, setting up his own practice, we could not have got a better speaker for this day. He is also a IRM level 5 practitioner, which is the highest certification level which the Institute of Risk Management offers today. I need to ask him, where does he find so much time? Because he writes profusely, he speaks at various forums, he has multitude of experience, and he is very active on various forums. So we welcome Mr. Warrior to this forum, and we really look forward to learning a lot from you, specifically in the area of how to set up and build one's own risk management practice. Now I come to Hersh. Hersh is, what should I say? He is a committee member who has joined us in the internal audit committee. So he's part of the BCS core family, so to say. But he also brings with him a strong collaboration between Bombay Chartered Accountants Society and the India affiliate of the Institute of Risk Management. What is most interesting is that at a very young age of 21 years, he decided that risk management was his area of interest and area of specialization. Hersh, congratulations to you, because very few people struggle about this even at the age of 60 plus, I can tell you from my experience. He has been, he's a commerce graduate. He's a member of our Institute of Chartered Accountants of India. He's an alumnus of IIM Bangalore. Technical specialist with the Institute of Risk Management. He's the CEO of the India affiliate of the Institute of Risk Management. And I must say that as a CEO who is here to bring risk management education and learning to people in India, he is doing an excellent job. If we, as Bombay Chartered Accountants Society, we line up a program jointly with IRM, we really need to run fast because they really run at a fast pace. So, so much for Hersh. He has taught more than 7,000 students at this very young age. I think he's aiming for the Guinness Book of Records very soon. He has been, prior to taking up this position as the CEO of the Institute of Risk Management, he has worked with KPMG. He has been recipient of various awards in his positions at KPMG. He has traveled extensively. So we have two people here at in two different age groups, both passionate about risk management, both having experience with large organizations, multinationals, and across the universe. And they are here to tell us as to how we can make a beginning in an area which they have found so interesting and so rewarding. So with these words, Mr. Warrior, I welcome you to our platform for the first time. And I am very certain that this is not the last time we are seeing you on this platform. So please enlighten us about your journey of more than 2.5, 3 decades, and particularly in the space of risk management. Thank you so much.
Thank you very much. Unless you told my name in the end, I thought that introduction was about somebody else. I never realized it's about me. Thank you very much for the kind words. And it was too big an expectation you're setting, but let me try to see what I can do here. Can you see the screen? Is it visible?
Not yet.
Not yet. Okay. So let me just try sharing it 1 second.
Yes.
Yes, now it's visible.
Okay, I'll make it full screen. Is it full screen now?
Yeah.
Okay. Yeah. Thank you very much for that. Those kind words, and it's a great pleasure to be here with all the chartered accountant professionals. And I'm the only person who is probably not in the line of chartered accountancy, so that's it's a privilege as well as a challenge for me because I have to put across points in a way which suits the the line of professionals, the line of profession which you're pursuing. So I would try to do that to the best of my ability. So let's see how it goes. To begin with, I would like to express my sincere thanks to both BCAs as well as IRM for giving me this opportunity to interact with all of you. What I plan to do today, this is not cast in stone. We can tweak it as we go about and maybe cover something else if the audience so desires in the question and answer session. But what I thought broadly we will cover is we look at risk management, enterprise risk management, and I promise not to bore you with any kind of theory and definition and textbook and all that. So all that you're much younger and smarter than I am to read and pick up. So what I'll try to do is I'll try to share experiences or the good and bad things I've done, and probably share with you some of the goof ups I've done so that you probably can avoid making those. Looking at ERM and also what do clients want? What are the things which a client would look forward to from a risk management consultant? What's the potential market that you're looking at? What kind of companies? What kind of assignments? What expectations are there from the risk consultant? And how can you set up a consultancy and run a consultancy in the area of risk? So this is broadly what I'll try to cover. I will keep these objectives in mind, try to share experiences, provide inputs that will help you explore consulting opportunities. So my objective in the next 1 or 1.25 hours is to give you the inputs which will help you determine whether risk consultancy is a line which you would like to pursue. Does it lie in your area of interest? Is it something which you would like to pursue? Can you pursue it along with your profession? So those things you can judge based on the inputs we have during this session is what I hope. And it should help you take a decision. It should help you also to go ahead and plan an organization for yourself, a consultancy for yourself, if you desire to move ahead in this. Of course, you can always seek the help of IRM and members like me of IRM who can assist you in doing that. So that's broadly what we'll cover. Let me start by looking at risk, because basically we're talking about risk management and consulting. Ultimately, risk lies at the bottom of the whole discussion we're going to have. The way risk is seen and perceived has changed drastically over a period of time. So I started my journey in risk way back in 1988. At that point of time, I had no awareness or liking or anything for risk. It was just a job which I took up in the insurance industry, which is by accident brought me into the line of risk management. Of course, I liked that and I continued in that line. So at that point of time, I felt if you are trying to explain to somebody that I'm working in the area of risk or risk management, people probably didn't understand what you're trying to do. They would ask, what is it that you do day to day? Whereas in the last 5-10 years, the kind of exposure which we have had, the kind of large risk events which has been happening, the reporting which has been happening is making people more and more aware. If you say cyber risk, everybody knows today, because you're doing internet banking, you're doing all kinds of transaction over the net, social media. So everybody's aware of what cyber risks are. So that kind of an awareness level has changed about risk. The impact has significantly changed because the values at risk are very high. So any event happening, the impact it can have on the organization, on associated organizations, very high. So today you're looking at a very high impact risk scenario where people have to evaluate how your organization is shaken up by a risk. The other point which I wanted to mention is about stakeholders. So these days, the expectation from stakeholders are very, very high. So you have the stakeholders expecting you to maintain the highest standard of corporate governance, for example. You have your customers expecting you to give them the best of risk protection, for example. So there are many of these escalating, escalating expectations from the side of various stakeholders, which put pressure on the organization. So handling risk is extremely critical for an organization. You would have noticed couple of days back, one of the car makers never realized that their counterpart in another country has made a tweet, a political tweet, and suddenly you had a campaign in India where people said boycott this car manufacturer, boycott their car. And the kind of impact they were facing overnight because of action of somebody else sitting in some other country was humongous. So it was like their reputation was taken to task. The customers were very, very worried whether this company will be prevented from operation, whether cars will sell. So the kind of impact which even small events can have, the kind of expectation from stakeholders. So the stakeholders, the car buyers are expecting that the company will maintain certain standards when it comes to expressing their position on any subject. So here a political subject, of course. So the stakeholders are very, very important. So somebody posted a picture on Facebook saying that I ordered I booked this car, but I canceled this car and bought a Japanese competitor's car because these people had tweeted like this. So that's the kind of impact which a small action somewhere else where you have no control can make on your organization. So managing those risks have become very important. The margin of error is very low. So you don't have the flexibility or the freedom of a big play. You can afford to make a mistake and correct. That's not very easy these days. The margin of error available is very low. The tolerance towards failure is not also very high. So heads will roll if something happens. The organizations will suffer if something happens. Customers will shift, stakeholders will shift, investors will put pressure. So there are lots of things which can pile up if something goes wrong. And also the distribution of resources, there's so much of pull that you need to look at the risk exposure of each option of yours before you can allocate the limited resources that you have. So risk in general is assuming a very, very serious, important proportion in all kinds of enterprise activities. So that's the first message that I wanted to give. Risk is assuming a center stage in many, many activities in corporates. And that is likely to increase. The way the trend has been, this has just gone up and it is likely to increase going forward. That brings us to the next point, which is about risk management as a line, as a profession, as a corporate activity. There's a definition on the right side. I'm not going into the definition. Basically, if you look at risk management, it is the way you're going to safeguard and optimize these three elements of your enterprise. Your plan. When I say plan, I'm talking about a very broad sense, in a very broad sense, plan. Where you want your organization to be, where do you desire your company to be, what is your strategic direction, what is the operational plan that you have to where you want to go, what's the roadmap you have. So the whole picture of where this organization is going to be 5 years later, that's what I'm talking about as a plan. So safeguarding that plan is a primary responsibility of risk management. Resources. When I say resources, I'm talking again in a very wider sense. It is financial resources, it's human resources, it is physical resources, it is digital resources, all those kind of resources available to an enterprise to pursue their objectives. Those resources, to protect and optimize those resources, is the next responsibility of risk management. And the third one is about reputation, how your organization is seen by various stakeholders. So reputation, again, in a slightly wider sense. So how do the external stakeholders see? How do the internal stakeholders see? How is your brand perceived? So all aspects related to your reputation of your organization. So if you see these three dimensions, protecting these three dimensions of your organization is broadly what risk management does. So this is not a textbook definition that I'm giving you. Why I mention these three elements is when you actually do an exercise in risk management, when you do an enterprise risk management exercise, you are going to keep in mind these three broad factors. Ultimately, you're going to design things in such a way that you identify all the risks to which these are exposed, and how can you actually design some mitigation mechanism to control the exposure on these three dimensions. So this is going to be at the back of your mind. So this is not a textbook definition is on the right side. this is what you would keep in mind when you're doing an exercise. So I'm just sharing it as my, not just mine, but any kind of risk consultant, when they work, they would have these three factors at the back of their mind when it comes to risk management. So we spoke about risk, the increasing importance of risk. Then we're speaking about risk management, because when you have risk and it is becoming more and more important, and it is being seen as very critical and very important in the whole enterprise governance and the way it is run, you need to focus on risk management. And risk management is nothing but your initiative in the organization to optimize, to control, to safeguard these three elements of your organization: your plan, where you want to go; your resources, what are the resources available for you to go there; and your reputation, how are you perceived internally and externally. So that's risk and risk management. And these days we have moved towards an enterprise risk management approach. So we used to have risk management as the jargon a while ago, but now we're moving towards enterprise risk management. It is a change in approach, so not just a change in the word, because earlier we had a silo-based approach. So you have, if you look at a company, the finance guy will do his financial side risk management. The operations guy will do his operations risk management. The human resources chief will do his human resources related risk management. There was no interaction between them. There was no sharing of information between them. There is no modeling in the organization to see how all these can come together and operate. For example, in a situation like COVID, which we faced, which we have been facing in the last 2+ years, a single event of COVID, a single pandemic, has hit all sides of the organization. So it has hit your revenue plans, because you're not able to really get the sales and the revenue we want. At the same time, it is hitting the ability to get workers to your work location. So you're not able to have physically people come to, if you're a manufacturing organization, physically people come to a factory and work, because you cannot have labor accumulating because of the COVID restrictions. So that's the, then you have overseas markets drying up, because this has affected other markets, and the general slowdown in business is affecting your. So there are lots of things which are coming at the same time and affecting various arms and parts of your organization, and that would not be handled very well by the earlier approach, where you see all these as pieces. It's like, if you see, many times people make fun of a high specialization in medicine. So if you have a doctor who sees eye, somebody sees the nose, somebody sees the ear, somebody sees chest. It's not, human being is one system. It's not really different parts. So that is why you always have a GP, a general practitioner, who will look and decide as to where the attention need to go of the doctor. So that kind of a risk management is what ERM is. You're looking at the enterprise as a whole, the impact of various risks on various parts of the enterprise, and how all these can come together, how it can impact the enterprise as a whole, and how do we manage it as a whole, not manage it in parts, but manage it as a whole. So we've moved away from the silo model when we adopt enterprise risk management. What we're doing is we are trying to see the enterprise as a single entity. We're trying to bring various arms of the enterprise together and manage. And another critical difference between ERM and the earlier risk management is that we're trying to be proactive here. Earlier, risk manager comes into play, or risk management action is triggered when something happens. Now here, what we're trying to say, what you're trying to do in ERM is to preempt things happening, to be proactive, to do things before something happens, so that you can control the outcome or reduce the impact of something happening. So this is a little more proactive than the earlier approach. And another very important thing is it also focuses on exploiting opportunities which are available. So a risk, if you just go back and see the definition we looked at, it only talks about uncertainty. It doesn't say that it is negative, though when we talk about risk, what comes to our mind is always things which can cause a negative output. It is not necessary, because a risk can also give a positive output, or some part of the risk can also give a positive output. So enterprise risk management also looks at the opportunity to exploit some of these positive outcomes of potential outcomes of risk. To give you an example, when COVID started in 2020, many of these automobile accessory, the suppliers to automobiles were affected grossly because automobile sales went down. But then it also came out that we are running out of ventilators. We have less ventilators in the country, and we were not able to order and get. And somebody figured out that many of these automobile suppliers had were manufacturing things which are very, very similar to the concept of a ventilator, so that they can quickly change, adapt their manufacturing and create ventilators. So there are many of these people, somebody in Mysore, even Mahindra, started looking at building ventilators. So COVID was a pandemic. It had a negative effect on the automobile industry, but you have an opportunity there where you can actually safeguard your revenue, where you can help the country tackle the pandemic and look at exploiting that opportunity. So that's what ERM helps you to do, not look at just the revenue loss, but you look at exploiting the opportunities available to you also. So this is very different from the traditional way of looking at risk, because there you're only trying to reduce your losses, cut your losses, ensure that you really are not hit beyond a level. You're trying to always protect yourself. Whereas here, you're trying to be proactive. You're trying to exploit what the risk throws at you. And that is a very different approach. How you see things is very different. And also, ERM gives a lot of importance to the risk culture, because risk is an inherent nature of people. If you see, so we loosely say he's risk averse or she's risk averse, or they are very risk taking and all that, which is not very precise in technical definition, but basically it tells you that risk is an attitude, is a culture, how people look at risk and how people handle risk. So that varies with individuals, but when it's an organization, you may want to create a particular culture so that everybody in the organization behaves the same way, because you don't want somebody operating completely differently from what the organization wants. So bringing a risk culture into the organization is also a very important aspect, which ERM is trying to tackle. So why I mentioned risk management and ERM as an introduction is to give you a flavor of what the broad concepts of risk that people are looking at today, because that's going to be the base for you to look at whether it's interesting to go into a consulting opportunity for this. So that's why I just wanted to lay the background of enterprise risk management, so that we can build and see how what client expects from a consultant, what kind of opportunities exist, what market exists, and is it something interesting for you. So we will go to that section to look at why do companies take up ERM, enterprise risk management. There are many triggers, there are many drivers. I've mentioned some of these here. These are, again, from my experience, from the type of assignments I have done, from where I get a query or what kind of proposals I make. So I've just abstracted from those proposals and queries that I get, and I find that there could be more. So this is limited to what I have faced. So this is not necessarily the complete universe, but this is a fairly good sample, I should say, because it cuts across several years. If I look at it, the compliance needs is very large. And this has been there for a long time, because compliance-driven risk management has been in vogue for a very long time. When any kind of regulator defines that if you want to run a company in this industry, you have to be compliant with these regulations. Naturally, people have to, they don't have an option. There's no need for them to see whether should I do it or should I not do it, because it is mandatory. So compliance-driven risk management is still there, because many highly regulated industries. So if you take banking, for example, banking risk management is built on a framework called Basel II framework, which is internationally accepted. And that is mandatory because banks are also not operating in as islands. They are all interacting across the globe. So they have common standards which are adopted across the globe, and there's Basel II is the basic framework which lies below the banking risk management. And there are a lot of, so if you go to RBI site and look, there are a lot of regulations stipulated. So some of these highly regulated industries like banking or insurance, some of the other mutual funds, for example, SEBI has released their guidelines as to how risk management should be done in mutual funds. So many of these highly regulated industries have strict frameworks to run, which means that you really don't have to sell the concept of enterprise risk management to that industry, because it's very well defined by and well documented by people who are experienced in risk management and who are professionals in that line. So that's one trigger. The second trigger is governance requirements. So when companies revise their corporate governance, or companies define the corporate governance, they want to have the best of corporate governance standards in their organization. They look at risk management, they look at enterprise risk management, because that's an integral part of corporate governance. So governance driven ERM is quite common. Because when you're defining governance, risk management is an essential part, enterprise risk management. And how do you set up a risk committee, and how do you have, for example, the best practice of an external director heading the risk committee? How does a risk committee report? How is the CRO fitting into the structure? So there are many of these corporate governance standards available. So when companies look at corporate governance, obviously they have to build an enterprise risk management framework within. Event driven is also there. So when some major event happens, either positive or negative, typically negative, the organization scrambles and tries to figure out, okay, how do we prevent this from not happening again? How do you prevent this from happening again? That's the time when people look at, okay, we need to have some focus on risk management. How do we do it? Shall we set up an enterprise risk management so that not only this similar events are also prevented from happening? So events drive organization into looking at risk management. That's a third trigger. Fourth trigger is leadership driven. There are many senior leaders who are visionaries, who have a very strong feeling that looking at risk, evaluating risk, and managing risk is very important to achieve their corporate objectives, achieve their business goals. So some of these leaders are very particular about risk management, and when they move from organization to organization, they actually take the culture to the new organization, and they push the concept of a complete enterprise-wide risk management across the organization. So leadership driven is another example. Resource driven. So when you have an opportunity to optimize your resources, you tend to look at it. So if this is a little ambiguous, so let me give you an example. In the insurance industry, there is a regulation to control the solvency of the insurance companies, which is called Solvency II, which is a European regulation based on which a risk-based capital model is accepted by many countries. So basically what it does is it defines what kind of a capital structure and reserve structure should an insurance company maintain to be solvent. And if you're not compliant with that, then your license will go and you cannot run the organization. Now, Solvency II, which is the framework which is adopted in Europe, says that if you have an enterprise risk management setup within, then you can actually have a more flexible way of defining your solvency capital and solvency requirements. So insurance companies are very interested in putting up a very good, strong ERM inside their organization, because that gives them the direct benefit of being able to release capital, being able to have lower capital blocked for solvency requirements. So that's very clearly driven by the resources. So here resources, the capital, financial resources. So the company, if they put in ERM, if they put in a lot of effort there, they are able to release capital. So that drives the organization. Sometimes it's the inherent nature of the industry, some highly risky industry, for example, some chemical industry, petrochemicals, for example, their risk management is inherent, built in, because that is seen as a high risk industry. That's seen as an industry, again, regulated from the safety perspective. So sometimes the inherent nature of the industry drives the risk management. And lastly, the corporate image, brand, publicity, positioning. So if you're very, very concerned about how the public, how government, how your foreign customers, all those see you, and your brand is very, very important for you. You may want to put this on because you don't want an event hitting and taking you by surprise and creating a negative impact in the society in general. So people also look at enterprise risk management to take care of these aspects. And again, these are not all one or the other. There are many organizations who take up enterprise risk management to handle many of these together. To give you an example, like while I was in Infosys, we had taken up an enterprise risk management initiative in Infosys, which ended up as a Harvard Business Review case study. That if you look at the case study, you can see that many of these factors play together. Corporate governance, for example, leadership, for example, brand positioning, for example. So Infosys wanted to create an image in the mind of the customers of theirs who are spread across all over the globe, that this is a company, this is a service partner of yours who is interested in ensuring that whatever you're entrusting us, it's safe with us. So people are entrusting either their critical computer systems or they're entrusting their processes to Infosys. So Infosys wanted to give them the comfort that, look, we are taking all steps possible to ensure that what you're entrusting us is very safe with us. Infosys also wanted to be seen as gold standard in corporate governance. So they wanted to tell everybody, look, we are governed in a way where it is transparent, it's very focused on managing all the risks. So if we, for example, give a guidance to the market that our growth is going to be this, it is going to be more or less that, because we have put a structure where our enterprise risk management will ensure that the goals that we have set will be achieved more or less very closely, unless something completely different happens. And if something completely different happens, then we have designed already a mitigation mechanism to face it. So that was what was driving Infosys as an organization. So you can see some of these factors acting independently or a combination of factors acting for organization to take up enterprise risk management. So why is it important? If you're running a risk consultancy and you're really going to a customer and you're trying to sell them your services or prepare a proposal or write an approach paper for them, you may want to keep all this in mind, because you have to figure out which one of these or what else is driving this organization to look at risk. If you don't find any of these driving this organization to risk, then you may want to find out what these organizations are thinking on these dimensions, and can you actually align risk with any one of them. So sometimes they may not be thinking about risk, but when they're talking about corporate brand, publicity, image, for example, you can say what happens to your brand if something like this happens. Or if they're talking about corporate governance and they're not really focusing on risk, you can say that, look, risk is very essential to this whole structure of corporate governance. So have you thought about it? So this gives you a sense of what people are looking at. This also gives you a sense of if you're going to approach somebody to get an opportunity, these are the levers that is available to you to write a proposal or talk to them or make a presentation or make a pitch or write an approach paper for them, or whatever is the way in which you're trying to sell your services. So that's why this is important to know where it's all coming from. Now, just to give you a sense of what kind of activities happen in ERM, because this is again something I would request you to just have a look carefully, because you may have to evaluate this from your perspective to see whether these are activities which you would like to do. Because when you take a decision as to risk consultancy, is it for me or not, this is something which you may want to keep in mind, because a typical ERM will contain all this. Now, again, let me tell you, an assignment will not contain all this. So if you're doing a consulting assignment, it won't have 1 to 9. It may probably involve 3, 4, 5, or in some cases it will be 1 to 9. In some cases, it will be only a few of them, or some of them may happen over a period of time. So this is not that all assignments will have these elements, but you're going to look at these elements, or you may have to tackle these elements when you do a consulting assignment. So I've listed it out so that you get a sense of what kind of assignments are people looking at when they talk about enterprise risk management. So a typical risk consultant would need to start from defining a strategy. So here you're going to define a risk strategy which is aligned, which is in line, which is harmonious with the strategy of the organization. So the organization will have a business strategy. The risk strategy stands along with that. It aligns with that. It ensures that the organization's business strategy is achieved in the best possible way. So you're going to think of a risk strategy which will align with the corporate strategy. So that is the starting point in a large organization. In small organizations, sometimes some of these get compressed, because if you're doing, for example, for a small and medium enterprise, it's not that they may themselves not have a big, huge strategy document or work done. Their strategy may be one page which somebody has written up, or it may even be in the head of somebody. So you may have, for example, strategy and policy merged together. But these elements are there. It may not be how detailed it is, how complex it is, how well documented it is, will depend on the organization, the size of the organization, the kind of culture which the organization has. But a risk consultant would need to be comfortable or need to focus on starting with defining a risk strategy. Then, of course, you need to go ahead and define the policy, or rather draft the policy and detail it out, which is actually the execution part of the strategy. So through the risk management policy, you're going to tell the organization, this is a strategy we have, and this is how we are going to run and implement the strategy. So policy is a document which is more detailed, whereas strategy is a document which is more conceptual. This is an operational document, and it will be detailed. It will be circulated to people. This will be referred by the larger organization. So this is documenting what you're intending to do, or how you're intending to convert this strategy into something on the ground. Strategy is conceptual. People, if you give a strategy document to somebody in operations, they won't know what to do. So the policy will actually tell them what to do, or how to implement that strategy on the ground. And of course, you need to build a team. How do you build a team? Typically, enterprise risk management requires a cross-functional team. So as I was mentioning when I started, it's not that we are operating in silos. We are operating as an integrated entity. And when you operate as an integrated entity, to run this, you need to have people from various skills coming together. So normally a team has to be built which is cross-functional, which has coverage from different parts of the organization, people from different functions coming together, and then forming a core team for handling the enterprise risk management. And these need not be full-time functions if the organization is small. If it is very large, you may have full-time functionaries in the ERM team. But if it is a small organization or a medium-sized organization, you may have people doing this as a part of their work. So they may be 85% into something, but they may be 15% into risk. So that kind of a split can be there in the team. And the core activity of risk management is number 4, which is evaluation, measurement, and mitigation of risk. So you're trying to assess or basically identify. So when I've written evaluation, I've actually combined many things. So it's, strictly speaking, you should say identify, evaluate, and measure, and mitigate. So I've just put evaluation as a general term, where you identify the risk, you see how impactful they are, you measure them in detail, identify what metrics can you use to measure them, and then figure out how will you actually tackle them, how will you actually get over them, or how will you actually handle them. So that whole item number 4 is the core of risk management. That is the core risk management activity. And mitigation will involve, there are multiple ways of handling, mitigating the risk. You can retain it, you can transfer it, you can reduce it. So there are different methods to handle all this. And evaluation and measurement involves various tools to identify and measure depending on the industry and all that. We will talk about that a little bit as we go forward. You also would need to define the processes of risk management. So ideally, the risk management process should not be a separate standalone thing. It should be embedded into what happens within the organization. So what happens, what processes happen within the organization, you will have to embed risk management into it. So if I were to give you an example, when we all use credit cards online, you get an OTP which you have to enter and to do the transaction, which is actually a risk management mechanism. So it is not that verification of the individual, whether it's a right person using the credit card, it's not done separately. It is embedded in the process of transaction or online transaction. So OTP, which comes to your mobile phone, which is registered with the bank, is actually, that's a KYC indicator. So they're trying to verify that the credit card details are entered by the right customer, by the person who actually owns the or holds the card. So for that, they're actually parallelly having a separate process where the one-time password number is forwarded to the phone of the customer. But if you see, when you're transacting, you're not seeing two different processes. It's one single process for you. So that is how you need to define the risk management process and integrate it with what happens in the organization. You don't really keep risk management processes separate and this separate, because people, when they run through the process, they should not even be thinking about risk management, because that's all integrated, embedded into the process. So defining those risk processes and embedding them into what the organization normally runs is the other activity which the enterprise risk management setting up involves. Then, of course, you need to define what kind of input you need to collect. Where would you collect the inputs from? Is it collected as much as possible? It should be collected from systems or somewhere where it is recorded rather than individuals. But there are certain things which you collect from individuals. So what do you want to collect? What format do you want to collect it in? Where do you want to collect it? What are the source points for these to collect? So those are all defined during this process. And you also, if it is a fairly large organization, you may also build some systems, some software to ensure that these data is collected, it is validated, it is taken from appropriate sources, it is periodically taken, all that. It's easy to ensure through systems. So building of systems is also part if you're dealing with large organizations. Smaller organizations typically may not really build a system. They may have an Excel sheet, or they may have some other kind of mechanism to hold, share, and manipulate data. Communication mechanism, very important. How do you communicate with your stakeholders, internal and external? So the policy, not only the policy, the periodic statistics, information, alerts. There are so many communication elements which are involved in ERM. Designing that whole thing, what will be the format, what will be the periodicity, what will be the mechanism of delivery? Is it a WhatsApp? Is it an email? Is it an alert on the dashboard? There are many ways in which you can deliver communication these days. So what should you do? How long it should be? What data should it contain? Which is the target audience to which you want to send this? There are lots of elements in this communication. So designing that, ensuring that how it will, or defining how it will happen is one of the other key elements of setting up an ERM. And the last one, which is quite big, is that introducing ERM into an organization is a big, huge change management initiative. So it's not a small thing where you just roll something out. No, you're trying to change the way an organization and all its members are looking at risk. So that's not a very small thing. That is actually a cultural change, and it requires a sustained change management initiative over a period of time. So it cannot be done overnight. You need to plan for a long time and slowly ensure that the message goes up to the lowest level. So it is not that ERM is going to be handled by the CEO and the board. That's not where it is. It has to reach up to the security personnel who is standing at the door. So the communication and the spirit of this has to reach that level. So it's a big, huge change management initiative. And if it is a large organization, it is even more difficult, because as you as the old adage goes, it's an elephant can run at 40 kilometers an hour and catch you if you run straight. But if you take quick turns, it's very difficult for the elephant to turn. The human beings being small and lower in weight, very easy for us to change direction. But an elephant with that much of weight and momentum, it's very difficult for it to take a turn. Whereas if you run in a straight line, it can catch you very quickly. So large organizations are also like that. If you want it to turn, it takes time. It takes a little bit of distance. Smaller organizations can do it very quickly. Larger organizations struggle. So change management is very important if you're doing it for a large organization. For small organization also, it's important, but it's easier to handle. So this gives you a sense of what kind of steps would an organization go through, or what kind of activities would you need to go through if you're trying to set up an ERM in an organization from ground up. It is not always that you have to do it ground up, because an organization might have done some things already, maybe in the name of ERM, maybe in the name of something else, maybe in the name of general risk management or just operational something. So you are going to build on top of it. But this is what the base structure of any ERM implementation is. And on the right side, what I've tried to do is I've tried to highlight what would be the role, or what kind of role would a consultant have. Where would the consultant be involved more, or where would the consultant be involved less? Just to give you a sense of, this is again not a very precisely measured thing, but it's to give you a sense that if you look at it, setting up of ERM is where a consultant can play a very large and significant role. For many of these activities, sometimes people depend 100% on consultants. So this whole procedure, there is a lot of dependence on consultants, even by very large organizations. So this is where consultants have a lot of activity. Now, this is how you run once you establish an ERM in your organization. How do you run it day to day? So these are some of the activities which are involved day to day, whereas periodic reporting. So if you say that every quarter this risk metric has to be reported to these people, or every month this risk metric has to be reported to these people, or if this metric exceeds this, then you have to report. So for example, if your sales target for a month goes below 10% of what you have budgeted for that month, then immediately an alert should go to these people. Or if the sales target goes down by 20%, then it has to get escalated to the CEO. So there could be many of those kind of rules which you define, and reporting will be driven by those. So that is the actual execution part. Defining that you would do in the earlier step, which I showed. Of course, stakeholder communication, managing the actual communication, review and revision, because these are not a one-time activity. Risks to which the organization is exposed to keeps varying. So risk is a dynamic environment. 3 years back, we never thought we have to model a complete shutdown of organization, a complete block of people coming to office, a complete ban on international travel. We never thought of any of those things. So risk is a dynamic thing. The environment in which risk operates is very dynamic. So you would need to review and revise your ERM periodically. You can't do it once and forget about it. It's not like do it once and forget about it. No, you have to keep revising. Periodically you revise, or you revise when some drastic event happens. So for example, if you've done an ERM, a complete process and everything, and finished it in Jan 2020, immediately after 3-4 months, you would have had to reopen it and review it as to what needs to be done, because in March 2020, COVID changed the whole paradigm. So all the assumptions you have made while designing the risk management framework and structure and the way you're running it completely would have changed. So you have to actually go and revise the whole thing. So review and revision is very, very, very critical. Training, because the information has to go to people. You have to train people to operate. The idea is people are not struggling when something happens. So when a fire happens in a floor of your office, if a fire happens, not when, if a fire happens on the floor of your office, who is the fire warden for that floor? People know whose responsibility it is. And the fire warden, he or she knows that what needs to be done. Call these people, evacuate them, ask them to accumulate in one point, push them through the stairs down to some place. Where do they stand? What kind of steps you need to do? All those will be documented and communicated. And people have to be trained. Drills have to be done. Information has to be shared and trained so that it comes naturally to them. It comes as second nature to them. Otherwise, it won't work in a real critical situation. So that so I remember when we did it in some drill in Infosys, the idea was to evacuate the campus in I think less than 4 minutes or something. So it's a campus with about 20,000 people. So you have to get this 20,000 people out in 5 minutes or 6 minutes, something like that. So that cannot happen if you start doing it at the time of a real event. So you have to keep periodic drills. You have to ensure that there are a few hundred people who are coordinating it, and they are able to handle it under a pressure situation by training them under some kind of a drills. So the timing of evacuation kept improving over a period of time. So when you do that drill 2-3 times, you're able to evacuate in a very quick time to whatever target you've set. So training is very important. Of course, updating and management of documents is another continuous activity. And this also, so if you look at the running part, the running part has actually lesser involvement of consultants. So which means that what I wanted to convey here, if you look at this, the setting up and running, during setting up, the involvement of consultants is very high. The amount of time which a consultant needs to spend is very high. In regular running, it is relatively low unless the consultant is actually running the risk management department for them. So people do outsource some part of this running. So the way you outsource processes to other organizations, people do sometimes outsource running of risk management to some consultant, in which case the consultant would need to take care of all this. But otherwise, if there is some kind of a risk management team inside within the organization, your as a consultant, your involvement will be less in this. So that's just the message I wanted to convey, and also what you would need to keep in mind if you're trying to look at this as a career option for you. Now, coming to what do companies look for when they're trying to get a risk consultant? What do they want, or what qualities would they look for, or what if they have floated an RFP? There will be questions which will be related to these points. So the company would try to evaluate the potential consultants who are applying to them, who are proposing to them, who are reaching out to them, whether they can cover these aspects. So first and foremost, obviously, is the risk management knowledge. You would need to know risk management as a process, as a procedure, as a structure, a framework. You need to have that whole 9 yards of theoretical knowledge, like what you get when you do an IRM program, for example. It teaches you from ground up what kind of a framework which needs to be in existence for effective ERM to run. So risk management knowledge, which is a given. Understanding of the domain is something which companies look for. So understanding of the domain, by that I mean, if your approach, if the client is a banking industry, they would expect you to understand a little bit of banking. If they're manufacturing, they would expect you to understand manufacturing. At least be knowledgeable enough to understand how that domain. You need not be an expert in that domain, but need to understand that domain. That's an added advantage. It is not that it's impossible for someone who doesn't. I've done assignment in industries which I don't understand. It is possible, but it is a strain, and you need a very strong supportive organization set up within the organization. Otherwise, you can't do it. So I always need to have somebody, a counterpart, who's sitting there who will fill me up on that on the domain part. Otherwise, I can't do that exercise. So understanding of domain is very important. Process awareness is also important. As I said, you need to know two things. One is the organization's base core business processes, as well as the risk management processes, so that the processes can be integrated and the risk management process can be embedded into the organization's business process. So that is also a very important. Okay, let me just see. I can't see the whole screen. Give me a second, please. Okay, the other point you're talking about is outside in view. So when you're inside an organization, when you're involved in day-to-day activity of the organization, many times your perspective is very limited or biased, or you are burdened by what the day-to-day activities of the organization is, and you have a lot of experience in the industry, so it's likely that you already have some preconditioned, conceived notions in your mind. So outside in view many times is very helpful when it comes to something like risk, which is open-ended. It's not that the scope of the universe of risk is not very limited. Universe of risk is an unlimited thing. So somebody who is not biased, who's not too constrained with the organization, preconceived notions of the organization, will be better. So a consultant sometimes is preferred because they come in with an outside in view. The next point you need to think about is tools knowledge, because there are many industries where there are specific tools for risk, especially risk identification and evaluation measurement. For example, chemical industries, you may have some specific models. Financial services, you may have, for example, a value at risk model, which you may use, or market risk or credit risk has some defined models in Basel. In insurance, there is a specific model. In retail, there may be multiple models to measure consumer behavior related risk. So knowing the tools is very important, because that has to be applied during the measurement part, which is the numerical activity, which is the activity where you're trying to assign some numbers to the concept that you're talking about. So tools knowledge is another thing which companies look for. Documentation skill is given because you're going to create a good set of risk management documentation which is going to be used by everybody. Convincing stakeholders. I was mentioning about change management earlier. Any change management initiative involves convincing multiple stakeholders. These stakeholders could be the senior leadership, could be CEO, could be board, could be employees, could be partners, could be intermediaries, could be regulators, could be any of those. All the stakeholders you have to see, and there may be requirement to convince multiple stakeholders, and that's also an essential skill which companies look for, especially if you have to convince your investor that the company is well prepared for to do something. Like I've done an assignment for venture capitals where they said, can you just look at the organization and see whether they can take this risk, some specific thing they wanted to look at. So that organization was taking my help to convince the venture capitalists that they have the risk covered. They're good to go. Their enterprise risk management is solid enough to face all this. And the venture capitalist is safe with the investment, and they can actually, in fact, go ahead and enhance the investment in the organization. So that's some skill which sometimes organization may look at a risk consultant having, because that's what, depending on the objective, they may look at this skill also. But convincing internal stakeholders is always essential. And building an organization, obviously, you would need to build a risk management organization if it doesn't exist. So these are some of the areas, some of the support which companies will look for, some of the skills which you would need to have to handle a good consulting assignment. Now, the question comes many times when I talk about risk consulting as to why should somebody have a consultant at all? Now, why do companies look at consultants? Why can't you manage everything internally in-house? Is it not possible to manage everything in-house? If you ask, yeah, it is possible. If you ask, is it impossible for an organization to run everything in-house? Not necessarily. You still can run sometimes all this in-house. But there are multiple reasons why companies look for consultants. And knowing this is important, because if I'm going to an organization and trying to talk and convince them into giving me an assignment, I would like to judge based on what of these factors are influencing them. So once I identify which factors are influencing them, it's easier for me to convince them that, look, you need to get me into the act because I can help you do this. So this is what a spectrum of things which I've again found. This is not a theoretical thing. It is what I have abstracted from the opportunities that have come across my way or the assignments I've done. So there are some hard reasons and some soft reasons. Hard reason is like clear facts and disputed, and soft reasons are, as you say, soft skills kind of things, some ambiguous, what you can feel. Those are the soft reasons. Hard reasons, straight, you don't want to dedicate staff. So some people are trying to just outsource the risk activity to you. They don't want to dedicate their people for risk. They may not have the people, or they may not want to recruit or train people, because they may have to train their people. When you want to train your people, you have to send them, invest on their training. You have to take out the time for training, and then you have to take out their time to do these IRM activities. So they may not want to do that at all. So they don't want to dedicate staff. So they want to outsource this to a consultant, or they want a consultant to run this so that their staff is not engaged with this. They want certified risk professional. Many times what happens is, if you want to convince somebody, if you want your risk management to be a good selling point, positioning point, brand making point for you, you may want to engage certified risk professional, because you would want to tell that, look, we have designed this enterprise risk management system. We have designed this risk management whole framework with the help of professionals. So that carries a little bit more weight. So certified professionals is another thing which companies look for from consultants. Time unavailable. So it's not unavailability of time of the consultant, but unavailability of time, or rather lack of, I don't know whether unavailability is a good word, lack of availability of time from internal resources, from people who are within the organization. They may have the skill, but they don't have the time. They just don't want to sit on this assignment at all. So that's a hard reason. So not having people, not having time from the right people, and need to have some certified professionals. The last one is, there's no risk management, there's no setup in the organization, there's no organizational support to run this within the company. So the company needs to have people support and an organization support to run, because you can put a person, but if there is no kind of organizational support, that person cannot make an impact. So these are the hard reasons. I don't have the people. I need certified professionals. I don't have time available from the right people. I have no infrastructure set up. I have nothing within the organization which will help me run this. Under all these circumstances, I would need to look for the help of assistance of a consultant. Similarly, there are many soft reasons. One is very poor internal collaboration. Many times, to run an ERM effectively, you need effective collaboration between various arms or the departments of the group. It doesn't happen many times. So you may have a consultant who, so I've done a couple of assignments. For example, I did an assignment which is not really a direct risk management assignment, but had risk management elements to it, where an multinational organization, they were trying to implement something with 13 countries collaborating. And these 13 countries, they don't see eye to eye. So country A will reject everything which country B says, and country B will not see eye to eye with country D. There are a lot of cultural elements. There are a lot of undercurrents in that organization. And some of it is not to do with nationalities, but the way that organization is structured. So there's some organization friction and politics and all that involved. So that, how do you overcome that poor internal collaboration? You introduce an external element who can liaise with all these people comfortably. So that's where a consultant comes. The consultant can speak to any of these entities comfortably. So I had a situation where, when you're running this workshop, like with 13 people from 13 different organization countries sitting, and immediately they'll start fighting, because they're all part of the same organization, same company, different geographies, but same company. So they have their internal frictions, and it will immediately come, and nobody will collaborate with everybody else. So my job was actually interacting with them separately, bringing them together so that I keep their interaction with me, prevent them from interacting with each other, and try to execute it. So poor internal collaboration is a big reason why many times companies look. And for ERM, you need collaboration from all arms of the group. Very important. Difficult to drive a large change initiative. I just mentioned about it a while earlier. Specialized professionals carry weight. So when you want to convince somebody, when you want to influence somebody into adopting something, specialized professionals help, because there's a lot of difference between a doctor telling us to do something and our friend telling that, why don't you try doing it? Because you give more weightage to what a professional is telling you. So that's another factor. And internal friction points. Okay, this is a very nice way of saying you do my dirty work. So internal friction basically is where two arms of the department of the organization doesn't work very well for whatever reason, and you get an external factor. So this is very, very closely related to the internal collaboration part, which we mentioned, where friction points are there and nothing falls in place because there is all these elements are not collaborating with each other, where a consultant can come and probably act as a layer of buffer, where people don't really have to face each other or deal with each other too much, but you can deal through the consultant and work it. So these are some of the soft reasons why a consultant may get an assignment. There are hard reasons and soft reasons. Hard reasons are clear and it will be visible. Soft reasons are not always visible. You may have to judge and understand that. A few things which you may want to keep in mind. This requires some bit of concept selling. So, okay, I will come to that as we go forward. You need to articulate the value of ERM. That is a little difficult to do because this is not very tangible. This is not something which is easily measurable. There are some areas where you can measure, but entirely measuring risk ERM impact is very difficult. So you would need to figure out surrogate indicators, not direct indicators may not be there. So you will have to identify a combination of direct indicators and surrogate indicators to convince the whichever stakeholder you're trying to convince that there is value in ERM. So articulating the value is very critical and it is a little difficult to do. So we need some effort here. You need to bring in some experience here, and as finance, as CA professionals, I'm sure you are better equipped than many other people to do it because you understand the dynamics of finance, understand the business models. So it's a little easier for you to do than many other professionals. So, but it's something which requires definitely effort. You need to build a bouquet of offerings because you're going to you're going to go to the market. You're going to approach the market with a set of offerings. So building a bouquet of offering is very essential. You need to refine an implementation process. Take the effort and so basically you're trying to take out the effort of the customer. You bring that's very closely aligned to what I spoke in the earlier slide. So you're going to free up the resources. You're going to reduce the effort on the side of the customer. You're going to bring in some standard models and artifacts. So this is another value where if you are a professional focusing this line, you're going to build some artifacts. You're going to build some models, which is easier for you to bring rather than somebody trying to build ground up. So it's like buying something and building something. So you don't want to spend the effort of building something. You can actually buy it easier. So the consultant comes with some ready tools and artifacts which they can implement, which is time tested and implemented in other organizations. So it gives them a quick start, head start. So that is something which can help the consultant. So it's important for you to keep building these assets which you reuse. Of course, you have the experience of running this in different companies. So something has gone well, something has not gone well. Some of the problems you have encountered, you already are aware that might be there in this organization also. So sharing the experience of implementing this somewhere else, applying that learning here is something which the consultant can definitely do. And that is something which is unlikely to exist within the organization because you won't have people who have worked, unless they've recruited some risk specialists who have worked in some other company as risk specialists. You may not have that skill. So this is a place where a consultant has a distinct advantage because you work on multiple assignments, multiple companies. So you have seen many more situations than what the internal company people would have. So you're better equipped to handle it than somebody inside. And of course, cultural change I mentioned about. Okay, this is, there are no good, strong, well researched market reports available to tell you this is what is out there in the market for you to attack. So I've just used some indirect indicators to give you a sense of what you're looking at. So typically, there are three broad areas which you can attack. One is the large enterprise and listed companies. Why I put large enterprise and listed companies together is because their governance structure has restrictions. So listed companies, even if it is a small listed company, they're supposed to comply with the governance structure required for transparency norms required for a listed company. So their governance is more regulated, more rigid, and they're likely to have better processes when it comes to governance than non-listed companies. So large enterprises, by which of being large enterprises, to run well, and normally most of them have adopted good governance practice. So large enterprises and listed companies usually have good governance, and it is up to us to link the risk management part to that. They may have sometimes a very not very well developed and not very well researched risk management framework within. Then you have the opportunity to expand it. But I didn't go too much into detail of that, is because when you're setting up a smaller practice in the early days, to attack large and listed companies is not very easy. So you may not be able to directly approach them. So I've not focused much on that. Whereas MSME is a big market and it is an untapped market. So today, MSME market is not really, they can't afford to get risk consultants, because risk consultants are usually expensive. They look for larger projects. They are not willing to do small pieces. So that is an unfilled piece in my view. So this is something certainly you can explore. So you have, according to the ministry study, I took it from the IBF report, there are 6 crores plus MSMEs and 20% growth and huge amount of loan. Why I took loan disbursal is, when credit is high, normally the demand for good risk management framework is also high, because when credit is high, somebody else is running the risk, and the financial service enterprise is running the risk, is always interested to see that the risks are well managed. When I say the risks are well managed, I'm talking about being predictable, not really that they have to create profit, or that's not what I'm saying. But the banks and financial organizations want predictability. They want predictability all the time, and for which risk management is what can assure that, give that quality assurance, or rather the assurance of something, some outcomes to them. So when this kind of financial credit involvement is there, and when it's a very growing market, that is a segment which a lot of individual and small organizations can look at. So this is an untapped market, fairly large. So if you, again, this don't hold me, what should I say, for this side, I'm just giving you an indication of consulting assignment size. And this is, I'm not looking at the big 5 kind of consulting assignments. That is going to be very large, because you're going to have put more number of consultants, and the per hour rate is much higher and all that. I'm just talking about in general. If you see, large enterprises may be willing to spend 10 to 25 lakhs on an assignment, and medium and small enterprises may look at 2 to 5 lakhs at best. So that's the size, ticket size you're looking at. So I'm giving you 2 pointers here, not really a complete market, what should I say, size measurement, but I'm sure you're smart enough to figure it out from this. You have about 6 crore enterprises growing at about 20%, with a very large amount of credit involved in this whole thing, which means that financial services are looking at this industry. Government is looking at this industry, because they are handling MSME itself has a big, huge department and minister and all that. So there is a lot of thrust from government on this. So this is a sector which is very important and very critical for Indian economy. And this is a sector where risk management is not really that, what should I say, that implemented in a well-structured way. There may be random pieces here there, but it's not implemented in a structured way. So this is a pie which is lying there, which nobody has really looked at tapping. One of the difficulties for large companies to tap this is a hugely distributed industry. So MSMEs are all over the place, and very difficult for large companies to go make proposals, spend that time to contact them, and won't be able to structure an assignment which is suitable to them and all that. So it won't work. It has to be a small boutique kind of organization which is dealing with them. So this is some thought which I would like to leave with you, because this is what you can think of as a potential opportunity to start. And this also, you can probably, you would do a cost benefit analysis by looking at how much you may have to invest to get a certification or train your people in risk, and vis-a-vis what you can get. So this is based on your exposure, reach, and the kind of companies you deal with. You can make a quick assessment on this. Now, I spoke about clients, what clients expect, what risk consultants are required to do, what market is there, and what is tapped, fairly tapped, which is the large and listed, less tapped or rather untapped is the MSME kind of sector, and what roughly could be the size of assignments that you're looking at, or or the ticket size that you're looking at. So that is just to give you a sense of the clients, the client expectations, the expectations from the consultant, and the kind of market that you can look at. Now, in the last part, in the third part, I'll try to quickly negotiate through what are the skills that a consultant need to have and how can you go about building this. So some of these are quite generic. This is not specific to risk consulting. If you look at it, this is true about most consulting activities. Basically, the thing is that you need to have analytical ability, problem solving skills, because believe me, no consultant has ever discovered anything. What you do is you collect data, you collect information, analyze it, and figure out what information you can see from that and structure it well and identify some areas where the company can improve and present it back to them. That is what a consultant does, irrespective of whether it is risk or anything else. And the information which you are seeing here is applicable to any consultant, not necessarily risk consultant specific, except some, if you see, for example, process orientation may be more important here, may not be in some other. So those kind of minor changes may be there, but otherwise this is a generic slide. But it is very important to have all these skills if you really, or at least some of these skills, or depth in a good number of these skills to be a good consultant and to be successful as a good consultant. Okay. Just my thoughts on, you're a better judge of this, but my thoughts on why would a CFIRM find this a sweet spot for them, or find this as something which is suiting them well. A few things. One is chartered accountants have a very strong footing on finance related, and that is extremely critical when it comes to risk management, because you're going to build the whole risk management thing based on the inputs you receive about the health of the company, the strength of the company, and most of it is revealed through some financial statement or the other. There are some things which are not revealed through that, but a large number of them is revealed by the financial statements. So for example, when I do an assignment, any company, before I go, once the proposal is accepted, once the deal is done, before I land up in that company or I start that assignment, I normally have a period of 10 to 12 days. And that 10 to 12 days is for me to collect all relevant financial statements and some strategy and those kind of documents from that organization and study thoroughly. Because that is where you get your base to go and start talking to people. Because otherwise you're completely blind. Once you get that, you get a very good grip of the organization. And most of the people who are on this session are better equipped than me to look at financial statements and derive information out of it. So that's something which is your strength, and that is something which is absolutely essential when you're trying to do an enterprise level risk management. Then some of the other aspects, like for example, you're very close to legal and compliance and all that, which is very essential when you're looking at enterprise risk management. There's a large element of legal compliance and all that, which you're very comfortable with. Strong in numbers, all chartered accountants are very strong in numbers, so that's given. You're already in some advisory capacity in some places. For example, there are many chartered accountants who are doing CFO roles, or what should I say, service as a CFO and all that. So there is an image of an advisory capacity that you're playing, which you can leverage, because as a risk consultant also you're doing an advisory capacity role. So that is something which you can leverage when you're working across. So that's another thing. Good insights via audit. So that is one very, very strong thing I find about chartered accountants. If you're involved in audit of different organizations, an auditor gets a view like none other, because you're seeing the organization across in a short time. You have access to all kinds of information. You can ask people for details, and nobody working in the organization gets that kind of exposure. So I still remember I used to work in in an insurance company, and we had a CAG resident auditor, those days in the public sector. So CAG resident auditor, after 3 years, this resident auditor was more competent technically than many other people in the organization, because that person was a very smart person, of course, and he had exposure to the entire organization. Whereas most of the people working either knew this or that, or this one of those pieces or two of those pieces. This person knew across, and he could put the pieces together. He knew how underwriting and claims and finance and investment, all that came together, which many of the people in the organization didn't know. So as auditors, when you do audit work, you're getting that visibility into what kind of business models, what kind of financial models, how do companies run, where are the good things, where are the bad things. So you have a lot of exposure, and that is extremely solid knowledge which you gain over a period of time. And if you're doing audit over multiple industries, then all the more better. So that's another fantastic strength of chartered accountants, or the opportunity which you have, which I think is very, very relevant in risk consulting. And of course, you have a lot of running relationships. You can leverage some of those as consultants. That's also going to be very good. But of course, there could be some conflict also. There could be some conflict of interest between what you're doing, and so you can't audit and you can't be a risk consultant at the same time. There could be some conflict there. You may have to reposition yourself if you're trying to sell, because chartered accountant is seen as in a particular way, and then you're trying to do something else on the risk. So you may have to reposition or rebrand your organization, or change the image of your organization to some extent. You may lack specific domain knowledge. That's applicable to many risk consultants, not just you. So that's another problem. Developing skills, whether you have the resources to develop skills, whether you have the willingness to develop skills, all that will be another factor. And most importantly, number 5 is very important. The way you sell a consulting assignment is very, very different, because in consulting assignment, you're selling a concept. Typically, for most of the assignments which you do as a chartered accountant, you don't have to establish the value of that assignment. You normally tend to establish, so correct me if I'm not very fully accurate here, but from what I have seen, most of the time you have to convince the client that you are the best party to execute it. Not necessary that this assignment is very essential for the organization, because that is a given in most of the stuff which you do. So you are trying to convince the client that you are the best person to do it. Now here, you may have to convince the client that this has to be done, and I am the best person to do it, and this is how I am going to do it. In many of the cases where your day-to-day operations happen, it is well established as how it is going to be done. And the client is not going to tell you that do something completely different. Whereas here, what you have to do is not perfectly defined. So you're going to sell something saying that this is very important for you. That's a first step. Once you convince the client this is very important for you, then you're trying to convince that I'm the person to do it. The client is happy with that. Third is you're going to tell this is the way I'm going to do it. And the client may completely say, no, this is not how you need to do it. You need to do it very differently. There you would need a different kind of sales to come to impress the client that this is the best way of doing it. So the sales approach has to be very different. So of all the factors, personally, I feel the most challenging for you would be to change the way you see how a proposal can be sold to a customer, or how an opportunity can be tapped. So that is where you may have to do some work. The rest of it, I think it's easier for you to cover. Very quickly, who are your competitors? Your competitors are going to be big risk consulting companies. If you're looking at the large and listed companies, it is going to be management consulting companies, because that's they're in the space of risk. Individual risk consultants are there. Niche domain consulting firms are there. Internal risk management team, because somebody may feel that they can do it internally. You don't need an external help. Of course, deep domain, these are the points which I have already touched upon. So this is what you're trying to compete with. So most of the time you're trying to compete with small firms or individual consultants and trying to get an opportunity. Of course, if you're trying to work with large firms, then you may have to compete with large consulting firms also. Very quickly, how do you go about setting things? 3 phases: decision making and planning and execution. You have to clarify your intention. Okay, this is the line for me. You have to decide that. Review the existing strategy. Does it fit in with what I'm doing? Does it fit in with my organization strategy? Check the alignment with that. Assess your strength. Does my organization or I have the strength to handle this? See what kind of skills you have. Are you willing to invest? Invest, when I say invest, not necessarily money, time, also in picking this up and getting the skills. Then you identify the skills which you need to augment. Probably if you're a firm, then assign some younger members articles to write IRM exam or some of those professional qualifications. Then you need to identify what kind of offering are you going to have, which target market, sales, internal communication. So these are fairly, again, standard across, irrespective of whether you set up a risk consulting or any other consulting organization. But basically, very important is that first and second. The third aspect you can probably define yourself, but the first and second, assessing whether this is what you want to do. Do I have it in me to do it? Am I interested in doing it? Do I have the skills to do it? Am I willing to invest in doing it? So these are the critical things you would need to look at. Once you decide, then you assess the skill, what you want to augment, get certifications, and identify the target segment and what you're going to offer. So that's broadly how you would go about setting it up. How do you identify potential assignments? Any regulatory change can trigger, as I mentioned, significant events, leadership. So these are things which if you remember the first slide, which I talked about, why do people go and do an ERM assignment? So this is an extract from that. These are all opportunities, and you can decide what you want to do, the last bullet point, based on the strategy, time, skill, selling ability, etc. You can decide what you want to do. Do you want to do pure advisory kind of thing? You do want to do some external validation or those kind of activities? Do you want to do strategy kind of assignment or an operational kind of assignment? What depth you want to go into? All these are factors which you would need to keep in mind while identifying the potential assignments. So structuring assignments, very quickly, I'm eating into Hersh's time. So let me try to be concise here. So the way you structure assignment will depend on the client's maturity, the organization maturity of the client, and the scope of work you're trying to do. So if it's a well-matured organization with a lot of documents and all that, you can do things quickly. Whereas if it is a less mature organization without much reference material and the scope of work, whether it is a large scope or a short scope, is it a small assignment, large assignment, all those factors will go into what would determine the assignment. So a rough figure I've given 8 to 12 weeks. It's not written in stone. You can't give a proposal 8 to 12 weeks. It can be, I've done 2-week assignments. I've done 6-month assignments also. So 8 to 12 weeks is a rough ballpark figure I'm trying to do. So you can structure many of these assignments in 8 to 12 weeks. Need not be, it to depend on scope, customer, many things. But I'm just trying to give you a flavor of what kind of assignments could be there. Just a couple of bullet points only here. You have 3 ways of doing it. One is you can actually build the expertise in-house, train people, learn, get inputs, and be experts, have experts in-house. Or you can develop some strategic partnerships with companies, organizations, or consulting firms which has the skills. Or you empanel freelance consultants and build your team slowly. So there are 3 ways in which you can build a complete risk consulting practice. You may have to do by getting external expertise, or by training your people through that. Partnerships are a little later in the maturity of the organization. The earlier stage, you will have to either build it, skill people inside, or work with customers inside. So quickly to conclude, it's a growing area of opportunity. There is a need for good risk skills for many organizations, big, small, and medium. Chartered accountants, with their background and the kind of work they do, they have a good background to build this. CA firms can look at risk consultancy as an opportunity to expand the range of services they are offering. And you can have multiple models of building some skill inside, collaborating with somebody, being partner to someone, and multiple ways in which you can actually build this whole exercise. So I would stop here, hand it over to Hersh to talk about IRM, and then we can take questions. Hersh, my apologies for exceeding the time by a few minutes.
No, absolutely not, Rama. I think it's been a wonderful session, and I must appreciate the great presentation that you've made It's actually served as a good resource and a good toolkit for anyone who wants to kind of understand how do you set up a risk consultancy business. So I won't take much time before we move into the Q&A session. If you see the World Economic Forum's Global Risk Report, the latest 2022 edition, it's very surprising and alarming to see that the entire risk perception survey of business leaders, academicians, consultants, risk professionals across the world, what does it say? 41.8% are saying that there is going to be a consistently volatile environment with multiple surprises as we move into a new world, as we move into a post-crisis scenario. And over the next 3 to 5 years, we're going to see these multiple shocks. 37% are saying fractured trajectories separating relative winners and losers. So it's very clear that through a risk management approach, as Rama has highlighted, there will be companies who will sustain, who will have built resilience, who will have risk-proofed their value chains, who will have business models which are innovative, which are sustainable for the long term. And on the other side, there will be organizations who are potentially, dying out or shutting down. And it's a survey, right? By 2027, the average lifespan of a company is not going to be more than 12 years. And that calls for a huge requirement for risk management, understanding and setting up an enterprise risk management function. And with that, a massive demand for risk professionals. Even if you look at the job market, there are more than 35,000 risk management jobs in India, and 45 to 50% of those are purely in the consulting and advisory space. And why is there a demand? The data is on the screen, where across the world, leaders are talking about fractured relations, fractured economies, uncertainties which are increasing, the so-called black swan and gray rhino events which are going to keep on coming up, whether it is climate change, whether it is digital inequality, whether it is natural resource crisis. And here are the top 5 risks or the top 10 risks which we are presenting as per the WEF. Climate action failure, extreme weather events, biodiversity loss, social cohesion erosion, livelihood crisis, something which we're already seeing in a semi-urban rural India versus an urban setup. Infectious diseases is going to again keep on increasing. We're already in the 3rd year of the pandemic, and there is no light at the end of the tunnel. While it's always important to be positive, but a risk professional always has to be prepared. And for being prepared, you need to know what can go wrong at any point in time. And you have to think negative in order to avoid these events having a major catastrophic impact on your business models. Again, human environmental damage, natural resource crisis, debt crisis, and geo-economic confrontation. So these 10 risks are going to actually cause massive disruption over the next 3 to 5 years. And as a qualified risk professional, as a chartered accountant who wants to enter into the risk management industry, you need to be prepared to help organizations mitigate the impact of these risks. Not all risks can be avoided. Like Rama mentioned, the essence of risk management is not that you can avoid all the risks, but you can reduce the impact of those risks. You can reduce the likelihood of those risks. You can bring it to an acceptable level within the risk appetite of an organization. Now, what are the qualities of a risk consultant, right? I've just summarized what Rama has mentioned in a very crisp way, because this is a key takeaway for all of you. Why should you look at risk consulting, and why will you be respected in the market as a chartered accountant? You will be able to command a respect amongst the other peers who are just domain experts. There can be a supply chain expert. There can be a management consultant who understands logistics and procurement. There could be a consultant who looks at accounts, tax, advisory. There could be a consultant who understands marketing and branding strategies. There could be a consultant who will prepare 5-year projections for you. But are you able to look at things from a risk lens? And that's where a risk consultant, a qualified risk consultant, will understand the need and importance of looking at things with a risk lens. What can go wrong in every department, in every sector, whether you're looking at a dependency on a vendor, or you're talking about a supply chain crisis like the Suez Canal, or you're talking about, a fake news which is going to affect your brand and result in a media trial. We don't know where we are headed. So how does a risk consultant help those companies? That's where you are one step above a regular department owner or a business head. The second quality is the ability to solve complex problems and mitigate risks in every domain. When you are working as a risk consultant, just bringing in Rama's point of stakeholder management, you're going to be dealing with a range of stakeholders from customers to suppliers to employees to investors. Back in time when I used to advise clients at KPMG Risk Advisory, we dealt with some of the large listed companies, and we actually went and took up surveys with customers. We took surveys with vendors. We assessed what are the issues that they are facing with the company, whether it is on the brand, on the pricing, on the customer servicing, after sales service, whatever it is. And when we started documenting all those in a risk register, we were then able to work closely with the management to identify mitigation plans. And that's the premium, that's the value add that you bring on the table as a risk consultant, because you have the ability to solve complex problems. The third one is you're going to help the organization reduce the impact of this risk. So this is something which I've already spoken about, where with the mitigation strategies that you develop, you'll be able to create a business continuity plan. You'll be able to develop a succession plan for MSMEs who are struggling to pass on the legacy to the next generation. You'll be able to develop strategies through technology where MSMEs are actually facing a survival crisis. The fourth one is take risk-based decisions. Now, here is where you're trying to inculcate, and I'll take the fifth point as well. You're trying to inculcate a culture of risk thinking. You want to force the management, you want to force the department owners, you want to force the subsidiary companies, the entire extended network of an organization to take decisions from a risk perspective. Whether you're coming up with an IPO, you want to export to Japan, you want to import goods from Vietnam, you want to recruit a large pool of talent and outsource that activity, or you want to merge with a company, you want to enter into a JV contract. All these decisions that you take, if you start looking at them first from a risk point of view and then convert that into an opportunity, the results will be much better. And again, that is where there is an opportunity to look at a success-based fee as a risk consultant, because now companies are willing to pay that if through this activity, through this risk mitigation which you have suggested, if it's a solution which is going to be workable and we are able to save X million dollars, then we are happy to share a percentage of that with the risk consultancy. And the last point is you're going to increase the lifespan of the company. I know it's a very ambitious statement, but according to me, risk consultants have the opportunity to make India risk ready. Here is the opportunity where there are 65 million MSMEs we are talking about. And I'm not even looking at the top listed companies, because those will be approached by the big four consultancies or the large management consulting firms. But as a tier 1, tier 2, tier 3 MSME chartered accountancy firm, here is your market, the 65 million MSMEs, and they will need a lot of support to increase the survival rate, increase the lifespan. And that can happen effectively through enterprise risk management. What are the risks? I think this is something we've already covered, but all these categories of risks are something that a qualified risk consultant will be technically capable to manage. I'm using the word very strongly, technically capable, because the essence of enterprise risk management is that you should know procurement, you should know legal, you should understand reputation crisis, you should understand marketing and branding, you should understand cyber security, you should look at the fraud risk management, the governance and board level risk, and lastly and most importantly, the people risk. Because in a post-crisis world, I think even the government has focused on mental health and mental wellness. People risk management is becoming a formal program in every company. And these are all new avenues which are opening up for risk consultants. Now, this is the 5-level pathway I want to introduce you to, where you can become a certified ERM professional along with your chartered accountancy. The level 1 exam is a 2-month exam. You got to study that. It's a virtual online exam. All BCS members get a 20% scholarship in the level 1 exam. Then you move to the level 2 exam. Again, if you're a chartered accountant with 2 years experience in risk management, you can directly go for the level 2 exam. You have an exemption from level 1. If you are a chartered accountant with 8 years experience, then you can directly go for the level 4, which is a certified membership. And as you know, Rama Warrier, he's a certified fellow of the institute. He's at level 5, right? So this is the 5-level pathway towards becoming a certified fellow in enterprise risk management. And this will give you that respect and tag of becoming a certified risk professional. At every stage from level 2 to level 5, you earn a professional designation. The level 2 exam happens in June and November. There are 360 exam centers in India. The level 3 is an online research paper where you get the designation grad IRM. Level 4 is a membership based application where based on work experience, you get the level 4 designation. And level 5 is after you hold the title of level 4 for 2 years and more, you become a certified fellow. Not just this, you're joining a global community in 140 plus countries. So let me introduce you to IRM. IRM is headquartered in the UK. We're present in 143 countries, and we are the world leader for ERM. There are a lot of qualifications available in risk management. Some of them focused on FRM, which is just financial risk. So, of course, you have a lot of audit-related qualifications. And then there is enterprise risk management, which focuses on all the categories and areas of risk, including the COSO and ISO frameworks. This is relevant for all sectors. So I think I saw another question coming up on my personal chat that is this relevant for certain sectors? It is relevant for every sector, whether you're advising a client in health, charities, retail, e-commerce. In fact, there are companies like Nykaa, Amazon, Flipkart, they all have a chief risk officer today, right? So you will be working closely with the chief risk officer as a risk consultant, trying to advise them on how they should focus on building a strong risk management framework, a risk register, risk mitigation plan within the company. So you will be joining a global community after clearing the IRM exams. There is a lot of opportunity for networking. In case you want to connect with someone in the Middle East, you want to connect with someone in the UK, you will be talking to fellow IRM members, thereby opening up even global opportunities of business for you. These are some of our certified fellows and certified members across the world. Jitendra Arora, he's a CFIRM Managing Director of State Street. Abhishek Paul, again, he's a level 5. Sundar Natarajan, he's the Chief Risk Officer of India First Life. Neeraj, he's a level 4. He's the Group CFO of Blue Star. And then you have other members from across the world. So this is the kind of elite community that is available for you to join along with your chartered accountancy, which will give you a lot of resources and networking opportunities. Now, how IRM and BCS are supporting you to develop your risk consulting practice. The first one is avail the 20% scholarship. Here is where we are inviting all chartered accountancy firms to build capability by nominating your young professionals and even leaders like you to clear the exams. If you are a leader with at least 2 years experience, please directly go for the level 2. There is an exemption form and you will be exempted from the level 1. If you are a leader with 4, but you want to go for the level 4 and you have 8 years experience, there is a pathway available for you as well. And you will be joining a community directly at the level 4 designation. And lastly, we're here to give you access to a range of risk publications and thought leadership documents with the global magazine at no cost. So that is the advantage that you get as a BCS member. You will be constantly supported with a range of publications and resources so that while you are working on your risk consultancy assignments, advising clients, you will also need to go back to the drawing board to access case studies, global business failures, what's happening around the world. How can you come up with an innovative solution? It doesn't sound as easy as we explained, right? I speak to Rama pretty often, and the kind of conversations, the kind of complex problems that even Rama faces from the clients, it requires him to constantly upgrade his knowledge. He has to come up with innovative mitigation strategies which are trending and which are relevant to the current times. So that's where these resources are going to really help you. And additionally, you get support to recruit from a global qualified talent pool. So if you're a chartered accountancy firm and you want to recruit some IRM qualified students, we'll be more than happy to support you. So these are the benefits that are available by virtue of being an BCS member. The link to that will be provided by Prajit again on the chat box. I've already shared it above, but in case you need the link again, please feel free to drop an inquiry and one of our team members will connect with you to help you develop your own risk consultancy and also help your students clear some of the level 1, level 2 exams. So with that, we'll now move to the Q&A section. Thank you once again. And a big thank you to BCS, Abhay Bhai, Nandita, Prajit. And once again, thanks Rama for conducting this session.
Thank you so much, Harsh. I'll first move on to the Q&A part. We have received certain questions from all the participants. So the first question is saying that as a CA in a second tier city, how can one explore the risk management area further? And does one need a big city presence for the same? Mr. Warrior, probably you may want to.
So sometimes big city presence can help, but COVID has been your assistant, because COVID has what should I say, changed the dimension of distance completely. So most companies are very comfortable working offline now. They don't really. So for example, I was to work for a very large corporate in Mumbai, and we finalized the start date as 25th of March 2020, and I was trying to convince them I can work from Bangalore, but the CEO was not convinced. He said, no, you have to come and sit in Bombay and you have to work here. But once COVID stuck, after 1 month, I did the whole assignment from Bangalore in the next 2 months. So companies have changed the way they are looking at things. So being a tier one sometimes can help, but not absolutely. So what you do is any assignment which you do, there is about 20 to 25% of the time you need face time with people in the organization, depending on 20 to 25 is a rough ballpark. Sometimes it is 10, sometimes it can be 40 also. So if you need to spend 20 or 25% of the time with the people in the organization, that time you need to travel. So I do travel. Consulting involves a lot of traveling. So you can spend that 20% of the time traveling. Rest of the 80% you can actually work from a small city. And if you're in a small city, you have a cost advantage also, because your cost will be low and you probably can give a more competitive price than what a big city competitor can give. So need not be a constraint, especially under the current circumstances. So you have a good opportunity. And also you have another opportunity, because people, there'll be a lot of, especially medium industries, which could be close to where you are or traveling distance from where you are, where big city consultants won't come and try to attack them. So you have a clientele, a potential clientele, which is close to you, which probably not many people are trying to tap. So these two are benefits for you. So you don't have to be put off because you're in a second tier city. You're well positioned to do well.
True. The second question is, which says, what are the international opportunities for the risk specialist?
Okay. So if international is a very generic word, so you have to go region. So for example, if you look at Europe and US, there are many companies which are, large companies are at a fairly mature stage. So for you to go and tap that, you would need to have some kind of an organization and sales structure and all that to tap that. But there are many other opportunities where the countries like Middle East, Southeast Asia, where untapped potential is there in market, which you can use. And also, if you have sufficient network people coming to you, many times assignments come to me not as risk management, risk consulting assignments. Assignments come in some other name. Though underlying is, so to give you an example, one of the Southeast Asian countries, their whole port as in the seaport, the ships where the ships come, that port was completely nationalized, and the government was discussing whether to allow private players to come. And the port authority, which is a public sector company, a public sector organization, was worried as to whether they can. So they approached to do an assessment of their state. Basically, it's a risk management assignment. So I didn't name it as a risk management assignment, but I did that assignment using the same tools I would do for a risk consulting. So the opportunities exist in many of these markets, depending on the level you can tap. Initially, well-developed markets may be more difficult to access, but some of these markets you have to, don't look at only risk assignments. There could be other assignments which people name differently, but would be the underlying spirit would be risk management. So you can look at those also. So international assignments available because distances are gone. You can sit anywhere and work in the world now.
That's true. The next one is, so some of the stakeholders, when you deal with them, they probably feel that, risk management does not add a lot of value. How do you keep convincing about, risk management add value to it? Second, should you keep, selling your services, risk management services to such stakeholders, and to what extent you should keep pursuing or you should stop?
Okay. So that's quite common. Not just risk management, any consulting, it's common where the customer says, I know this business for a long time. What are you going to tell me? So few things you can do. So I can share what I try to do in those kind of situations. One, I try to collect some information about the company where things have not gone very well. Try to model in some way and talk about that as to how it could have been avoided by doing. So articulating the value of risk management or ERM by taking some real life example, if it is available. If it is not available, try to speak to people, use LinkedIn, connect with somebody, get some information, see if it is possible. If that is not possible, try to take a competitor organization where something has happened and it could have been avoided or it could have been managed better with a good ERM. Talk about that. In all possibility, it may be applicable here also. Use that. Or just write an approach paper. So in many cases, I just make a presentation of 10 slides of my thoughts on what the organization should be doing. I put a caveat saying that I don't know whether you're doing this. You may be doing 5 of these, but at least 5 of these you have not done, you have not thought about. So why don't you look at it? So there are different ways in which you approach whether you should leave it or not. It depends on the ability for you to pursue, the effort you need to pursue. The ultimate result, if you really get it's a worthwhile assignment, either from an experience perspective or a brand perspective or a revenue perspective, then you may pursue longer. If it is not, then you may drop it.
Thank you so much, sir. Harsh, probably for the betterment of the rest of the crowd also, you could just mention about the costing scenario. I saw a lot of questions coming up on the costing for the certificates. So probably you could just mention it once for the betterment of everyone else.
Yeah, so the level 1 exam globally, if you pursue it outside India, it's almost 80,000 plus VAT. But for all Indian candidates, it's for 29,500. That includes the handbook, the online resource center, the examination portal access, and the alumni membership. And again, for BCS members, there's a 20% scholarship on the 29,500. So that's further reduced. The level 2 exam goes to 1,83,000. And that will give you a designation IRM cert. It's recognized across the globe. It takes about 9 months to clear the level 2 examination, and there are 360 exam centers in India. I did see a question on whether there's an exam center in the West. Yes, there are a lot of exam centers. You can check with our exam reservations team. And then level 3 is an online dissertation. So it's a research paper which you need to submit. And once you clear the level 3, your designation is further upgraded. I'm also seeing a question, can a non-CA studying for CA can answer this? Yes, absolutely. So Kamlesh will definitely reach out to you if you could provide your contact details. There are a lot of CA students who are currently pursuing CA. They are going for the IRM exams while they are clearing their CA exams. What are the prospects for a qualified ACCA with more than 30 years in finance? Satish, I believe you will be eligible for a level 2 or a level 4. If you have worked in risk for 8 years, you may be eligible for level 4. If not, you can directly go for the level 2. So again, there is a process to get that done. If you could share your contact details on private chat with us, we'll get someone to contact you and we'll proceed with that. Hemant, yes, it's applicable to working CA. We've already discussed that. It'll help you in setting up a risk consultancy, expanding your opportunities in risk management. Like I said, there are more than 30,000 job openings at multiple levels from internship to director to a chief risk officer. So if you're a CA and you want to enter the risk industry as a leader, these qualifications will help you across the globe.
Yeah, I think you've covered.
And a CA practice having more than 10 years experience, then what are the gateways available? Again, Hardik, we'll have to evaluate your profile and see if you're eligible for any exemption. So you can register your inquiry with the BCS and we'll get in touch with you, or you can share your contact details and we'll come back to you ASAP.
There's one last question. I mean, is it allowed to practice simultaneously with the CA practice?
Yeah, there is no regulation which stops you from practicing CA and doing risk, right? There are so many CA firms who've diversified into risk consultancy and doing other activities? I think Nandita also would be the right person to address this from an institute perspective.
Thanks, Hersh. According to me, there are CA firms who are already doing risk consulting assignments. The conflict is at a client level or at an assignment level, but doing a regular assurance practice or a compliance practice along with some consulting advisory assignments, it is completely acceptable and even encouraged, because today large number of CA firms are looking to move away from entirely compliance driven practices into more consulting based practices. So that is one, definitely. I think the other thing, though not a specific question, I have seen in the last 10 years a lot of younger article students who trained with us, who have a lot of them have looked at opportunities of migrating abroad. And I have found that a lot of people who came from the stream of internal audit, risk management, and forensics have had an easier, smoother transition. So since there are a lot of young members who have registered for this course, it may also be a possibility that they may want to explore, because certifications like the IRM, they consolidate your knowledge, they create a strong foundation, and they also create a credible qualification when you are looking at opportunities outside the boundaries of your country or your geography. So
thank you, ma'am.
That's all from
just a few announcements before we move to formal vote of thanks. So BCS has a couple of events coming up in next few days. The first one being the 55th RRC, the general RRC, which is the traditional program of BCS. It is held between 24th and 27th of February. There'll be various topics and there'll be various speakers along with it. Since the outstation has already been booked up, we are only accepting virtual registrations now. Second event being a panel discussion on the budget 2022, the economy, taxation and capital market. That's held on 22nd of February at 6:15 p.m. It's a lecture meeting. The registration details will be shared in the chat box. The third event is the 22nd DTAA study course. It's a double taxation avoidance agreement course, which is a comprehensive course on international taxation, including the overview of transfer pricing, FEMA, Black Money Act, and so on. Though it has already started, but people can still join in a day or so. This course is extended till 20th of March. And again, it has various speakers and various topics on international taxation. The next one is by the IA committee, the Internal Audit Committee. That's the Forensic Accounting and Investigation Studies course. It's an ongoing course. You can register for it. Again, the details will be shared in the chat box. And there's one other thing that's called TaxCon 2022, which is again being held in a hybrid mode. That's been held on 18th and 19th of February. It's on a Friday and a Saturday. And the venue of it is at BKC, at the ICAI auditorium. So request all the people to register if they are interested in the TaxCon 2022 as well. Moving on to the formal vote of thanks. It gives me an immense pleasure to deliver the vote of thanks at this session in the first place. I would like to thank Mr. Warrier for, taking out such time, as Nandita ma'am mentioned before, that, he is so much active in so many activities that he keeps on performing, right? From writing books to articles, and then, being a part of the events. He found out some time and delivering us with his experience and the insights from his life, of sharing the do's and don'ts, as to about how to develop the risk management consultancy practice, explaining about what ERM is, how to set up ERM, and why do companies look outside for consultants. Also the potential markets for the beginners. So that all sums up into the entire session details. And I would also like to thank Hersh for, bringing out the importance of certification in developing the risk management consultancy practice, how the certification by IRM can help the professionals to go global and deal with many new business opportunities. So I thank both of you, and we look forward for many more sessions from you, sir. Thank you so much.
Thank you. Thank you, everyone.
Thank you very much.
Thank you.